What's going on, everyone? Today is day 29 of the 30-day $500,000 challenge. Really excited to give everybody a kind of conclusion tomorrow of how it went. And again, really glad I did that. Really can't thank everybody enough who supported it, reached out, all that, even supporting the 30 days of the Facebook Live videos. Today, the second to last day, I was going to provide just kind of a high-level overview of the difference between a debt promissory note investment versus a syndication. Now, again, before I even get into this is just a matter of opinion. Before setting up either, please consult with your own attorney. You're going to need some documents for both, such as a promissory note, being able to file first position or second position lien at the county records or at the land records. As long as on the other side, if you're doing a syndication, there's only a few attorneys in town who can even do it. You even have expert with SEC regulation, and you really need to consult with them. You're going to need a private placement memorandum. You're going to need a subscription agreement as well as an operating agreement, and just kind of a general structure for putting all those documents together that's in line with SEC regulation. The last thing you want to do is go out and sell an investment to someone who can't actually make an investment into your fund or your project, and then you end up in some very serious trouble. So again, don't set up either without consulting your attorney first. Any attorney can put together a simple promissory note really quickly. So you're fine there. But again, if you're thinking about setting up a syndication, you need to go consult a few attorneys here in town. If you're curious who does it, reach out, and I'll be happy to provide some recommendations. But so kind of getting into it, there's the $500,000 challenge. The main goal of it, of course, I've raised a lot of money in the past for our syndication projects, because at the end of the day, your time really does matter. It's usually not worth syndicating a small single family home or a small deal unless it's a huge flip. So we'll syndicate, we'll take on equity investors for our larger apartment complexes, our mobile home parks, etc. For all of our single family home projects, we'll either just do it ourselves with our own cash, or we will bring on debt promissory note investors, which is what we're currently raising money for now, which is something that I haven't really focused on in the last 3 years. But you put yourself out there, and there's lots of people looking for that type of investment that I'll dive into a little bit here in a second. But there's kind of four main factors. The first, again, being the qualifications. With a debt promissory note investment, anybody can do that. Now, I would argue some people even aren't qualified to do that. But even if somebody who has $20,000 who wants to lend 10, if they've got somebody willing to take that $10,000 at the terms they come and agree upon, well, there's no one that says that they are not competent and able to make that decision on their own. It is the easiest way to think about a debt promissory note investment is it's a loan. You are providing someone a loan completely independent of how their project does. They are going to pay you, if you agree on monthly payments, they're going to pay you each month regardless of how the project goes. Like, it's not tied to the returns of the project at all. And sometimes there is a kicker at the end. For example, if you're estimating a certain number of profit, and you say at the end the investor gets a set $5,000 fee for their time involved, but there is no tied to, if this investment does $100,000, they get this. If it does $150,000, they get this. There's none of that. It is not tied to the performance of the investment, or at least it shouldn't be, because if it is, you're kind of crossing over into syndication territory, and you really need some different documents. But so again, qualifications, anybody can do a debt promissory note. Again, the simplest term to think about it is a loan. It is usually personally guaranteed. Again, you have a promissory note, and you're usually getting a first or second position up to a certain loan to value of the property as security. Now, with a syndication, you have to be an accredited investor, which means you have to have a net worth in excess of $1 million, not including your personal residence or the equity that you have within it. And if you're single, you have to have made $200,000 in excess over the last 2 years on your tax return, or if you're married, you have to make over $300,000 combined over the last 2 years to be considered accredited. Now, there is kind of the argument with syndication that if you own, several rental properties, that you could be a savvy real estate investor in order to make that decision and qualify with SEC requirements. However, I mean, I've never taken money from somebody in that situation, but I know some people do. I would advise you not to. If you're going to go that route, of course, make sure you get a written notarized document from their CPA as well as that person's attorney stating that they are in fact competent to make that investment. And I wouldn't consider anybody a savvy real estate investor until they have at least 10 homes, if not more. I mean, that's a bare minimum, but again, at the end of the day, wouldn't you rather be safe than sorry? So again, that's why I've never taken money from somebody in that situation. I've advised them to do a debt or promissory note investment. Kind of the next factor is the security or structure. So again, the security of a debt or promissory note investment, again, you're getting a first or second position lien on the property. Okay, so that means that if it doesn't go as planned, then you could theoretically foreclose on that position, take that property back, and then sell it in order to recoup some of your proceeds as the investor. You also have a personal guarantee, or at least I hope you do, against the borrower. So you could actually go after them personally in order to recoup some of those funds as well, or go after their other assets. I mean, you have, again, it is not tied to the performance of the project. You are able to take that project back though, or the real estate that it is tied to, as your security, or you're able to go after this individual who has borrowed the money as your security. Again, as far as structure, you're going to want a personal guarantee, promissory note, and then as far as like structure, I mean, what I usually do is monthly payments of either principal and interest compounding, or just straight interest only, with some sort of balloon in the future. This is usually going to be a 1, 2, 3, 4 year investment. What I usually like to do though is, say this is going to continue on a month-to-month basis, and give my investors an option that at any point within 6 months, they can request their money back and I'll return it. So if they lend me money today and tomorrow they say, hey, I have a family emergency, I need it back, then I'm required to give it back to them within a 6-month time frame. Of course, 6 months. If I'm using this money to buy houses with cash, renovate with cash, and then cash out refinance with a local community bank, that doesn't take 6 months, that entire process. But again, always under promise so that you can exceed expectations and over deliver. Extremely important. Structure with a syndication. Again, you do not have a personal guarantee. You do not have a promissory note. Your investment is 100% tied to how this project does. So if the project does bad or does not go as planned or as projected, because nobody 100% knows up front. I mean, there are projections, which are estimates, which are assumptions, which at the end of the day are guesses. Now again, someone who's been in the industry doing it a long time, they can make a very educated guess, but at the end of the day, syndication is any investment is essentially a guess at the very start of it. But so you do not have a promissory note. You are 100% tied to how this project goes. So if it is a plan of a cash on cash return of X% and there is no cash to distribute, at the sole discretion of the manager, they may not distribute any cash. If you plan to sell it at year 5, but you can't sell it or the market's turned, well, you're not getting any of your money back at the sole discretion of the manager. So again, on one side, the debt promissory note, you are very secured. Again, that's my opinion. I want to make that very clear. That is my opinion. You are secure with the promissory note. You have a lien on the property. Worst comes to worst, it's going to be a hassle, but you're probably going to get the majority of your money back as long as you've been fairly vigilant on, hey, has this investor just been taking this money and not even putting it in this property? On the other side, again, you're 100% tied to how this property performs, which can be great. That usually means the returns are going to be higher. But again, worst case scenario, you have to hope you're making an investment in the management team that if this project doesn't go as planned, they're going to do everything in their power to correct it, or they're going to fire sell the asset and hopefully return at least some of your investment. But you can't go after them for any money you lose. Again, there's no promissory note, there's no personal guarantee, anything like that. The next aspect of it is looking at the two is liquidity. So when you're thinking about making an investment in either one, again, a debt promissory note investment, you're agreeing upfront for here are the exact terms. If you agree to 1 year, you're getting your money back at 1 year unless you give the written option for both parties to extend on a month-to-month basis. But you know exactly when you should get your money returned, or you have the exact option to call your money due within a certain time frame. So it is very concrete. It's not as liquid as investing in the stock market, or in crypto, or whatever those investments that you can pull the kind of the same day. But your money is fairly liquid. You could say that this investment is on a month-to-month basis, and within 30 no's you get your money back. Now you're probably going to be getting a lower return to request terms like that, but I have seen them before. And sometimes you and an investor can make that work, and that's a 30-day notice. That's a fairly liquid investment. On the other side, you have with your syndication, that is a non-liquid investment, almost about as non-liquid as you can get. You are making, again, investment in this project, a project that requires syndication, usually a large project, or at least in order to be worth the manager's time, it's got to be a large project. And so usually this is a 1 to 5 year plan, again, projection. And again, it may not go as planned, and the management team may need to hold for 10 or 15 years in order to make this make sense, or at least in order to return some of the investor's money. You do not have the option to request your money back at any time. The best you can do in most situations, again, every manager is going to set this up differently, but is to sell your portion at a discounted rate to recoup some of your money back. But it is extremely illiquid, and you can't just request your money back at any time. You can't say, oh, here's a 30-day notice, I want my money back, or hey, this isn't going as planned, I want my money back. You can't do anything like that. It's extremely non-liquid. And so, again, that's another reason why you should be accredited, is you're making a long-term investment into this project. You shouldn't need that money back anytime soon. This shouldn't be your rainy day fund and nothing like that. This should be money that you are 100% okay with losing and should plan probably to lose. That's just the safe way to invest in general in a syndication project. Then you also have, lastly, your ROI. So what is your return on your investment? Again, a promissory note, I consider that a debt promissory note. I consider that a fairly safe investment. Again, you're making an investment largely into the person because it's personally guaranteed, and if they are savvy enough to complete this as originally planned. But your return for having that security, for having that first or second position up to a certain loan to value, is going to be less. Now, I've seen people take this money as low as 2-3%, all the way up to 12% before, and even higher sometimes. Again, a lot of it has to do with whatever terms you're able to negotiate. We usually take this money at 7%. We are currently raising this money at 7% for the $500,000 challenge. But depending on your experience, depending on the project length, depending on maybe you set the terms up with the investor that you'll give them 12%, but you're not making monthly payments. You just make a balloon payment at the end of the project. Well, yeah, you might have to pay a little bit higher interest rate to not make those monthly payments. So it's all negotiable, but at the end of the day, it's going to come down to your experience and the general terms, the length, and the speed at which, or the velocity of the money. For example, if I'm talking with a lender or a private lender, and they can give me $500,000 tomorrow, and I'm much more likely to pay a higher rate for that than I would for someone that I talked to for 5 months who's got $50,000, and that's all they're going to invest. Now, the speed of money is incredibly valuable, because what if you find a big deal that you want to take down and there's a bunch of people competing for it and you get it? Again, I don't recommend environments like that. But let's say you get a deal, you might need that $500,000, you might need it tomorrow, so it's important to have people like that who can help at least close projects that need to be closed on an extremely fast time frame. So I'm kind of getting off topic, but the conclusion, or the synopsis, is money from 2 to 12, sometimes even higher percent. And don't let, if you're new to investing and you can't find anyone to give you money at less than 15%, don't let that stop you necessarily from doing a deal. Again, in Tulsa, I would be concerned that Sharp or a different hard money lender wasn't willing to lend on it at 12. I think they're doing 12.75 right now, with a few points. But if you're doing a flip, above 175,000 ARV, possibly you had to reach out to somebody else. If the numbers still work, don't let that stop you. Don't let your ego stop you from doing a deal just because somebody wants a good return on their money, and probably justifiably so. If you're brand new to real estate, this is your first project, they can demand a lot higher rate rate from you than if you've been doing this for years and have taken their money and given it back successfully before. As far as ROI for syndication, how we've structured it in the past is a 7 to 9% preferred return, which again is not a guaranteed return, but it is a quarterly distribution of cash based on their investment. Again, solely dependent on how the investment is performing. It means if there is money to distribute, the investor will get the first 7 to 9% cash on cash. Above that, the investor is getting an equity split. So let's say if there's more than the 7% agreement that we come to as far as the preferred return, then the investor of all the money distributed above that gets a certain equity split. So it's a 50-50 investment. The investor would get 50% of all cash above, and the management team would get 50% of the cash above the 7% that is split. Again, so one of the benefits is if you're investing in a syndication, you get your money first. So if there is money to distribute, the manager isn't making any money unless they exceed the preferred return that they have set. Again, preferred return, I've seen them way lower than 7%. I've seen them way higher than 9%. It all depends on the project and on the team's experience. And at the end of the day, any investment you make in real estate where you have somebody else running the project, you are making an investment more in the team than the project. A good team can make a bad project work. Now, it helps to have a good team and a good project, but you know what I mean. And so we've never done higher than a 30% equity split to our investors. Our kind of general rule is if we have to go above 30%, then we're stretching. We're trying to make a project work where the numbers just really aren't there. Because what's the easiest way to give your investor a better return? Well, just increase the equity split. Well, if you have to go above 30%, there is a point at which it's not worth your time to even do the project because you've given so much of it away. And if you have to give more than 30% away, again, our rule is you're stretching. This isn't a project you should probably be doing. And on determining the preferred return, year one, they should start around 7 to 9%. And hopefully this is a value add project or an undervalued project. And year 5 will hopefully creep up to above 10 to 12%. Now, depending on what you agree upon, again, it comes down largely to your experience. As have you done projects like this in the past? Excuse me. But if you're buying something that has a large renovation, you could probably expect to give a larger preferred return than if you're just buying something that is turnkey day one, doesn't need a large renovation. Again, it all comes down to your experience and the size of the perceived risk of this investment. But for our syndications, we usually shoot for a 15% IRR. So we're shooting for a 5-year cash refinance of the property. They're returning all of our investors cash, and then they are just an equity owner from there on out, but the preferred return goes away. Again, there is so many different ways to set up a syndication as well as a promissory note. It really comes down to how your project fits. Now, for example, there's people who will do a syndication with no monthly payment, no preferred return, just a straight equity split. That's the simplest you can do, and if you can find someone who will agree to that, that's incredible. And there's other people that I've heard they're giving 80% away to their investors and doing a 12% preferred return. Hopefully they're brand new, or that's just a humongous project, because otherwise it just wouldn't be worth doing for the management team. But that's kind of my high level overview. Again, the $500,000 challenge, we started this because I've raised syndication money before. And actually, I feel like I have in excess of, probably $2-3 million I could raise at any time for investments like that. But our single family home business is growing rapidly. Those projects don't make sense to give away any equity. Like, we like doing those on our own, which means that we have to secure the investment. We have to sign personal guarantees and to raise money in order to go and do these projects with, debt investments. And we're okay with that. But so we've been raising 7% money. It's going really well. Back when I first started, we were taking money at a lot higher interest rate. And, again, as you start to build a track record, you can demand a lower rate from, people who feel more comfortable with your investment, knowing that they're giving it to somebody who's done dozens and dozens, hundreds of homes in the past. So again, the biggest thing on negotiation is going to be your experience level. And if you're not experienced, partner with somebody who is, and you can probably raise money a lot cheaper. If you have any questions, please reach out. I'm excited to provide kind of a final overview of how this went tomorrow. Again, if you have any questions about either of the two options of investment, please reach out. I'd love to get connected, and thanks everybody for watching.